Before we begin, it's crucial to understand that I am not a registered financial advisor, and this presentation is for educational and informational purposes only. The contents of this video should not be considered as financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. You should always conduct your own research and consult with a qualified and licensed professional before making any investment decisions. Past performance is not an indicator of future results. Imagine this for a second. Your mortgage payment is due on the 1st of the month. Your car payment is due on the 15th. The power bill, the water bill, the internet bill, they all show up like clockwork every single month. Your entire financial life, every bill you pay, operates on a monthly schedule. So why in the world does your investment income show up on a completely different calendar? For most investors, income from their stocks arrives once every 3 months. It's called a quarterly dividend, and it creates this bizarre mismatch. You're living in a monthly world, but you're getting paid on a quarterly schedule. It's like trying to pay your bills today with a paycheck that only arrives at the end of next month. It feels disconnected, it's hard to budget, and it forces you to constantly manage cash flow instead of letting your money work for you seamlessly. What if you could fix that? What if you could press a button and sync your investment income with your real-life expenses? What if you could get a predictable, consistent payment deposited into your bank account every single month, just like a paycheck, but from your investments? That's not a fantasy. It's the entire purpose behind an investment vehicle that most people have heard of, but few truly understand: the monthly dividend mutual fund. And over the next few minutes, I'm going to pull back the curtain and show you everything. We're going to break down exactly how these funds work piece by piece. We'll explore who they are designed for, and just as importantly, who should absolutely stay away from them. We will uncover the hidden risks and the potential rewards, so that by the end of this, you will have the clarity to decide if this strategy is the missing piece in your own financial puzzle. See, the world of investing is filled with jargon designed to make you feel like you're not smart enough to participate. Words like yield, expense ratio, ex-dividend date. It's confusing by design, but the concept of getting paid from your investments is actually incredibly simple. Let's start at the very beginning. What even is a dividend? Forget the textbook definitions. Think of it like this. Imagine you own a tiny piece of a massive successful pizza parlor, a company like Apple or Coca-Cola or Johnson & Johnson. Every day, that pizza parlor sells thousands of pizzas and makes a ton of profit. At the end of the year, after they've paid for the cheese, the pepperoni, the rent, and their employees, they have a big pile of cash left over. That's the profit. The people who run the company, the board of directors, have a choice. They can take all that profit and reinvest it back into the business, maybe buy a new, bigger oven to make even more pizzas next year. Or they can decide to share some of that profit with the people who own the business, which is you. When they decide to share it, they take a slice of that profit pie and give it to you just as a thank you for being an owner. That cash payment, that slice of the profits, is a dividend. It's that simple. It's your share of the company's success, paid directly to you in cash. Now, most big, established American companies that pay dividends, they do it on that quarterly schedule we talked about. Once every 3 months. One payment in January, one in April, one in July, and one in October. Or maybe they pay in February, May, August, and November. The schedule varies, but the frequency is almost always the same, 4 times per year. So, if you only own 1 or 2 stocks, your income is going to be lumpy and infrequent. That's where the second piece of our puzzle comes in. The mutual fund. What is a mutual fund? Again, let's ditch the jargon. A mutual fund is like a giant financial potluck. Imagine you want to have a huge party, but you only have $5 to spend on food. You can't buy much with that. But if you get together with 100 of your friends, and everyone throws their $5 into a central pot, you suddenly have $500. Now you have enough money to go to a big warehouse store like Costco and buy a massive variety of snacks, drinks, and desserts. You can get chips, pretzels, soda, cake, cookies, a little bit of everything. A mutual fund does the exact same thing, but with investments. Instead of you taking your $500 and trying to buy a few shares of 1 or 2 companies, the mutual fund pools your money with millions of other people. They might gather billions of dollars. And with that giant pool of money, a professional manager can go out and buy hundreds or even thousands of different investments. They create a diversified portfolio, a little bit of this company, a little bit of that company, all bundled together into one single thing that you can buy. It's an easy way to own a small piece of a huge, professionally managed collection of assets. So now let's put these 2 simple ideas together. We have dividends, which are slices of company profits, And we have mutual funds, which are giant potlucks of different investments. A dividend mutual fund, therefore, is simply a giant potluck where the professional manager has only one rule. They are only allowed to buy stocks of companies that pay dividends. They are on a mission to collect as many of these profit-sharing companies as they can. This is where the magic happens. This is how we solve that mismatched calendar problem. The fund manager isn't just buying 1 or 2 dividend stocks. They might buy 200 of them. And here's the key. All of those 200 companies operate on their own unique dividend schedules. So, Company A might pay its dividend in January. Company B pays in February. Company C pays in March. Company D pays again in January. Company E pays in February, and so on. From the fund's perspective, it's not getting paid 4 times a year. With hundreds of companies in its portfolio, it's getting dividend checks in the mail almost every single day of the month. The money is constantly flowing into the fund. The job of the mutual fund, then, is to act as a financial smoothing machine. It takes all of those lumpy, inconsistent, quarterly dividend payments that are flowing in from hundreds of different sources, collects them all into one big account, and then divides that total income up into 12 equal pieces. It then sends one of those pieces to you, the investor, every single month. You are still getting the profits from all those great companies. Nothing has changed there. But instead of you having to track hundreds of different payment dates, the fund does all the heavy lifting. It transforms that chaotic quarterly income stream into a smooth, predictable monthly payment that lands in your account on or around the same day, every single month. It syncs your investment income with your life. It turns your portfolio into a personal cash flow machine. This is the core promise of a monthly dividend mutual fund. It's designed for a specific purpose, to generate regular, frequent, and predictable income. It's a strategy often favored by people in or near retirement, who want to transition from growing their nest egg to living off of it. They want to replace their old work paycheck with a new, investment paycheck. But it's also gaining popularity with younger investors who just love the psychological benefit of seeing their investments pay them every single month. It's tangible, it's motivating, and it makes the power of compounding feel real. But this all sounds a little too good to be true, doesn't it? A steady monthly paycheck from your investments, all handled for you? There has to be a catch. What are the costs? What are the hidden fees that can eat away at your returns? Are these monthly payments guaranteed? Or can they be cut when you least expect it? And what about taxes? How does the IRS treat this monthly income? And are there tax traps you absolutely need to know about before you even think about investing a single dollar? That's exactly where we're going next. We're about to peel back the next layer and look at the real-world costs and the critical risks you cannot afford to ignore. First, let's talk about the price tag, because nothing in the world of finance is ever truly free, and that monthly check comes with a cost. It's often a cost that you don't see directly, a silent drain on your account that works against you, day after day, year after year. The most common and most important cost is something called the expense ratio. Think of it like a subscription fee for the fund. It's an annual percentage taken directly out of your investment to pay for the fund manager's salary, the research analyst, the marketing, the administrative paperwork, everything. You never get a bill for it. It's just quietly siphoned from your returns before you ever see them. Now, you might look at an expense ratio of, say, 1% and think, 1%? That's nothing. But that's exactly what the fund companies want you to think. That 1% is one of the most destructive forces in long-term investing. Let's put it in perspective. If you invest $100,000, a 1% expense ratio costs you $1,000 in the first year. But it's so much worse than that. It's not just $1,000. It's $1,000 that is no longer in your account, growing and compounding for you. Over 30 years, that seemingly tiny 1% fee can devour nearly a third of your potential returns. A third, all handed over to the fund company for the privilege of them managing your money. It's a slow leak in your financial tire. You might not notice it day to day, but one day you'll wonder why you're so far behind where you thought you'd be. But the expense ratio is just the cover charge. Sometimes there's a bouncer at the door demanding a ticket. These are called sales loads or commissions, and they can be brutal. You'll typically see funds categorized by different share classes, usually Class A, Class B, and Class C. This is just a fancy way of saying, how would you like to pay us? Let's imagine 3 friends, Tom, Rick, and Harry. They each decide to invest $10,000 into the exact same monthly dividend fund. Tom buys Class A shares. These come with a front-end load. The moment he invests his $10,000, a commission, let's say 5%, is taken right off the top. So $500 goes straight to the broker, and only $9,500 actually gets invested for Tom. He's already in a $500 hole from day one. Rick chooses Class B shares. These have a back-end load, or a contingent deferred sales charge. It sounds complicated, but it just means there's no upfront fee. His full $10,000 gets invested. The catch? If he needs to sell his shares within a certain period, maybe the first 6 years, he gets hit with a penalty that declines over time. It's a financial handcuff designed to keep you from leaving. Finally, Harry buys Class C shares. These have no upfront fee and no back-end fee. Sounds great, right? Wrong. Class C shares typically carry the highest annual expense ratios of all. That 1% we talked about might be closer to 1.75% for Harry. It's a level load that he pays every single year, for as long as he owns the fund. It's a permanent drag on his performance that can end up being the most expensive option of all in the long run. 3 friends, same fund, 3 drastically different outcomes, all because of a choice they might not have even understood they were making. So you've got the expense ratio, you've got the potential sales loads. But we're still not done. There are also the hidden costs, the ones not even listed in the expense ratio. Every time the fund manager buys or sells a stock or a bond for the portfolio, they have to pay trading commissions and deal with something called the bid-ask spread. These costs are buried inside the fund's performance, quietly eating away at your returns. A fund that trades frequently, what's called high turnover, can have significant internal trading costs that act like a secret second expense ratio. Now, as crucial as understanding these costs is, they are at least quantifiable. You can look them up. The real danger, the one that can truly blindside an investor counting on that monthly income, lies in the risks. And the biggest risk is the fundamental misunderstanding of the dividend itself. People see that monthly payment hitting their bank account and they think it's a guarantee. They think it's like a salary from their investments. It is not. That dividend is a promise, and it's a promise that can be broken at any time. Think about where that dividend comes from. It comes from the profits of the real companies the mutual fund has invested in, companies like AT&T or Coca-Cola, or your local utility. And what happens when the economy takes a nosedive? When a recession hits, people buy less, profits fall, and companies get scared. The very first thing they often do to preserve cash is cut their dividend. And when the companies in your fund start slashing their dividends, the monthly check you get from the fund shrinks right along with them. Imagine a retiree who has carefully budgeted her life around a $2,000 a month dividend check. Suddenly, a market downturn forces half the companies in her fund to cut their payouts. Her fund's income plummets, and her check drops to $1,200 a month. Her financial security is shattered, not because the stock market crashed, but because the income she thought was a rock-solid guarantee turned out to be written in sand. But it gets even more insidious than that. There's a dark secret in the world of income funds that you need to be aware of. It's called return of capital. It sounds harmless, but it's one of the biggest red flags you can find. Here's how it works. Let's say the fund has promised a high monthly payout to attract investors. But this month, the stocks and bonds it owns didn't generate enough actual dividends or interest to cover that promised payment. So what does the fund do? Does it lower the payment and admit it fell short? Often no. Instead, it will sell a small piece of its holdings, your holdings, and give you back your own money disguised as a dividend. They are literally returning your own capital to you and calling it income. It creates the illusion of a stable, high payout, but what's really happening is the fund is slowly liquidating itself. It's like taking $100 to an ATM, withdrawing $20, and having the machine print a receipt that says, "Congratulations on your $20 of income. You haven't earned anything. You've just taken your own money out of your account." A fund that consistently relies on return of capital to fund its distribution is a ticking time bomb. You feel good getting that check each month, but your underlying investment, your principal, is being eroded with every single payment. Beyond the dividend itself, these funds are exposed to other powerful risks. A big one is interest rate risk. Many monthly dividend funds hold a lot of bonds or stocks that behave like bonds, such as utility companies and real estate investment trusts. These investments are extremely sensitive to changes in interest rates. The rule is simple. When interest rates in the economy go up, the price of existing lower-rate bonds goes down. Why? Because no one wants to buy your old bond paying a 3% coupon when they can buy a brand new one that pays 5%. Your old bond becomes less valuable. So as the Federal Reserve has been raising rates to fight inflation, Many of these safe income funds have seen the value of their holdings get hammered. And that brings us to the most basic risk of all, market risk. The simple fact that the stocks and bonds inside the fund can and will go down in value. People get so focused on the monthly yield that they forget to check their account balance. A fund might be paying out a juicy 7% dividend, but if the fund's total value dropped by 15% that year, you've still lost 8% of your money. You're getting a monthly check from a bucket, but there's a giant hole in the bottom of that bucket. The income becomes a dangerous distraction from the fact that your principal, your nest egg, is shrinking. You're losing dollars to collect dimes. So you have to navigate this minefield of costs, expense ratios, sales loads, hidden trading fees. You have to understand the very real risks that dividends can be cut, that you might just be getting your own money back, and that rising interest rates and falling markets can crush your principal. It's a lot to keep track of. But even if you master all of that, even if you find a low-cost fund and fully accept the risks, there's one more trap waiting for you. A silent partner in your investment that can take a huge bite out of those monthly checks before you ever get a chance to spend them. It's not the fund company, it's not Wall Street, it's Uncle Sam. And how these dividend payments are taxed is one of the most misunderstood and potentially costly mistakes an income investor can make. To understand this, you have to realize that in the world of investing, not all income is created equal. Imagine you get 2 paychecks for the exact same amount, say $1,000. But when you go to cash them, the bank tells you that on the first check, you get to keep $850. On the second check, you only get to keep $680. Same work, same pre-tax amount, but a wildly different outcome. You'd want to know why, right? You'd want to get all your future paychecks from that first company. This is precisely what happens with dividends. They fall into 2 main categories, and the difference between them can mean thousands of dollars in your pocket or in the government's over time. The 2 categories are qualified dividends and ordinary dividends, which are also called non-qualified dividends. Let's start with the good stuff. Qualified dividends. The word qualified is your clue. These dividends have met specific requirements set by the IRS, and because they've qualified, they get special treatment. They are taxed at the lower, long-term capital gains tax rates. For the vast majority of Americans, that rate is 15%. If your income is below a certain threshold, around $89,000 for a married couple in 2023, your tax rate on these dividends is an astonishing 0%. You pay nothing. And for the highest earners, the rate tops out at 20%. So 0, 15, or 20%. These are the good tax rates. So what does it take for a dividend to get this VIP treatment? 2 main rules. First, the dividend has to be paid by a U.S. corporation or a qualified foreign corporation. Second, you, the investor, have to hold the stock for a specific period of time around the dividend payment date, typically more than 60 days. For a mutual fund, the fund itself does the holding for you, so as long as the fund is investing in these types of companies, the dividends it passes on to you can be qualified. Think of dividends from blue-chip stocks like Apple, Microsoft, or Coca-Cola. These are the classic examples of payments that generate qualified dividends. This is the check where you get to keep most of the money. Now let's talk about the other check. The one that gets a huge bite taken out of it. These are the ordinary or non-qualified dividends. The name says it all. They are taxed at your ordinary income tax rate. This is the same rate you pay on your salary, your wages, or any other regular job income. And for most people, that rate is significantly higher than the 15% for qualified dividends. We're talking 22%, 24%, 32%, 35%, all the way up to 37%. Suddenly, that 15% tax rate on qualified dividends looks like an incredible bargain. The difference between paying 15% and say 32% is massive. It's more than double the tax bill on the exact same amount of income. So what kind of income gets hit with these higher ordinary rates? This is the critical piece of the puzzle for monthly dividend investors. It's not just dividends from stocks that didn't meet the holding period. The big sources of ordinary dividends are things like the interest payments from bonds, or distributions from real estate investment trusts, also known as REITs, or income from certain master limited partnerships. Essentially, a huge chunk of the high-yield universe that isn't a standard U.S. stock falls into this category. And here is the trap that so many people fall into with monthly dividend mutual funds. To generate that consistent high monthly payout, these funds can't just rely on stocks. Stock dividends are usually paid quarterly, not monthly. So to smooth out the income and boost the yield, fund managers load up on other assets. They buy tons of bonds. They invest heavily in high-yield corporate debt, often called junk bonds. They buy those REITs we just talked about. All of these things are fantastic at generating steady cash flow. But, and this is the million-dollar but, the income they generate is almost always classified as an ordinary, non-qualified distribution. It's taxed at your highest marginal tax rate. So you might see a fund advertising a juicy 7% yield. You think, wow, 7% a year paid out monthly, sign me up. But you look under the hood and you discover that 80% of that 7% yield is coming from bonds and REITs. Only 20% of it is from qualified dividends. Let's run the numbers because this is where the theory becomes painfully real. Let's say you invest $100,000 into this fund. That 7% yield generates $7,000 a year in income for you. Of that $7,000, only 20% or $1,400 is a qualified dividend. The other 80% or $5,600 is ordinary income. Now, let's assume you're in a common tax bracket, say the 24% federal bracket, and the 15% qualified dividend bracket. On the qualified portion, that $1,400, you'll pay 15% in taxes. That's a tax bill of $210. But on the ordinary income portion, that $5,600, you'll pay your full 24% income tax rate. That's a tax bill of $1,344. Your total tax bill on that $7,000 of income is over $1,500. Your effective tax rate on that juicy 7% yield is actually over 22%. Your after-tax income isn't $7,000, it's closer to $5,400. Your real, take-home yield isn't 7%, it's 5.4%. That's a massive difference, and it was completely hidden behind the headline yield number. The tax man just skimmed 1.6% of your entire investment value right off the top every single year. This is what we call a tax drag. It's a constant, relentless force pulling your returns back down to earth. And the higher your income, the worse this drag becomes. If you're in the 35% tax bracket, the math gets downright terrifying. So how do you avoid this trap? How do you know what kind of dividends a fund is paying out? You have to become a financial detective. First, at the end of every year, your brokerage will send you a tax form called a 1099 DIV. This form breaks it all down for you. Box 1A will show your total ordinary dividends. Box 1B will show the qualified dividends. Here's the secret. Box 1B, the qualified portion, is already included in the total in Box 1A. So your mission is to see how close the number in Box 1B is to the number in Box 1A. If they're almost the same, congratulations, your fund is incredibly tax efficient. But if Box 1B is only a tiny fraction of Box 1A, you know you're paying a huge chunk of your dividends at higher ordinary income rates. But you don't want to wait until tax time to find this out. You want to know before you invest. You can do this by going to the fund company's website. Look for a section called Distributions, Tax Information, or Portfolio Characteristics. They will often have a chart or table that shows the breakdown of their historical distributions, what percentage was qualified income, what was non-qualified, and what was something called return of capital, which is a whole other story we'll get to later. This is your treasure map. It tells you the true after-tax potential of a fund. Now, after hearing all this, you might be thinking this is all too complicated and that monthly dividend funds are a terrible idea. But there is a get-out-of-jail-free card, a way to completely sidestep this entire tax nightmare. And that is by holding these funds inside a tax-advantaged retirement account. Accounts like a Roth IRA, a traditional IRA, or a 401k act like a protective shield. Inside that shield, the distinction between qualified and ordinary dividends becomes meaningless. All of the income, all of the distributions, all of the growth happens tax-deferred or, in the case of a Roth IRA, completely tax-free. The IRS can't touch it while it's inside the account. You can receive that 7% yield, have 100% of it classified as ordinary income, and it doesn't matter. You pay zero tax on it in that year. This allows the full power of your investment to compound without the constant drag of taxes. This is arguably the single most important strategy when it comes to investing in high-yield, income-focused funds. If you plan to hold them in a regular taxable brokerage account, you absolutely must do your tax homework. If you hold them in an IRA or 401k, you can focus purely on the quality of the fund and its strategy, knowing the tax man has been locked outside the gates. Understanding this difference is the dividing line between an amateur income investor and a pro. The amateur chases the highest possible headline yield. The pro understands that the only yield that matters is the one you get to keep after taxes. But taxes are only one hidden force eating away at your returns. There's another, more subtle cost that most investors completely ignore, and it has nothing to do with the IRS. It's the silent killer of compounding, and it's baked right into the fund itself, siphoning off your money every single day, whether the market goes up or down. This silent killer is called the expense ratio. And if you've ever looked at a mutual fund's fact sheet, you've seen it. It's usually a small percentage, something like 0.5% or maybe 1.2%. And your brain, like my brain, is wired to see a number that's small and just dismiss it. 1%. What's 1%? Feels like nothing. Feels like a rounding error. It's the financial equivalent of a service fee on a concert ticket, annoying, but you just pay it and move on. But this is precisely the trap. The financial industry is brilliant at psychological framing. They know that calling it a 1% fee sounds infinitely better than telling you the truth. And the truth is, over the lifetime of your investment, this tiny, insignificant-looking fee can devour a third or even half of your potential earnings. It is the single most destructive force working against the average investor, and it operates in total silence. So what is it exactly? An expense ratio is the annual cost of owning a mutual fund, expressed as a percentage of your investment. Think of it like a subscription fee. You're paying for the privilege of having a team of supposed Wall Street geniuses manage your money. That fee covers everything. The fund manager's multi-million-dollar salary, the team of analysts, the fancy corner office in Manhattan, the marketing budget, the legal compliance, the administrative paperwork. A mutual fund is a business, and you, the investor, are the customer who pays for all of its overhead. And here's the most important part. This fee is not charged to you once a year. It's not a bill you get in the mail. It is deducted from the fund's assets every single day. A little microscopic sliver is shaved off your investment, day in and day out, rain or shine. If the market skyrockets, you pay the fee. If the market crashes and you lose 20% of your money, you still pay the fee. The fund managers always get paid. Let's put this into perspective with some real numbers, because this is where the illusion of just 1% completely shatters. Imagine you invest $10,000 into a monthly dividend mutual fund. Let's be generous and say it has an average annual return of 8% before fees. The fund has a 1% expense ratio, which sounds pretty reasonable. In year one, the fund's assets grow by 8%. Your $10,000 becomes $10,800, but then the fund schemes its 1% fee. Now, here's the first critical mistake most people make. They think, okay, 1% of my profit. 1% of that $800 gain is just $8. I can live with that. But that's not how it works. The fee is 1% of your total assets. 1% of your $10,800 is $108. So right away, your actual return isn't 8%. It's 7%. Your account ends the year at $10,692, not $10,800. $100 or so vanished. Again, it doesn't feel like a catastrophe, but compounding is a force of nature like gravity, and it works both ways. It can compound your wealth, or it can compound your losses. That $108 they took from you in year one, that wasn't just $108. That was $108 that is now no longer in your account, no longer working for you, no longer compounding for the next 20, 30, or 40 years. Let's fast forward. Let's keep that same $10,000 investment and see what happens over 30 years. In one scenario, we have a magical fee-free fund that gets that same 8% return. After 30 years of compounding, your initial $10,000 would grow to a staggering $100,626. A beautiful result. Now let's go back to our fund with that tiny, insignificant 1% expense ratio. Remember, this means your actual return each year is only 7%, not 8. You start with the same $10,000. You wait the same 30 years. But at the end of that period, your account balance is only $76,122. Let that sink in. The difference is over $24,000. That's more than double your initial investment. An amount of money that could be a new car, a down payment on a house, or years of retirement income has simply evaporated. It vanished into the pockets of the fund company, all because of a fee that looked like a rounding error on a piece of paper. It was siphoned away so quietly, so gradually, you never even saw it leave. And here's the real kicker when it comes to monthly dividend mutual funds. Because they are often actively managed, meaning there's a person or team making decisions about which dividend stocks to buy and sell to generate that monthly income, they tend to have higher expense ratios than simpler funds. It's not uncommon to see expense ratios of 1%, 1.25%, or even higher. A simple S&P 500 index fund, by comparison, might have an expense ratio of 0.03%. The difference in long-term results between those two is astronomical. The expense ratio itself is actually a bundle of different fees. The biggest chunk is usually the management fee, which is what pays the portfolio manager. Then there are administrative costs for the day-to-day operations. But my favorite and the most outrageous is something called a 12b1 fee. This is a fee the fund charges you, the existing investor, to pay for its own marketing and advertising to attract new investors. You are literally paying them to print glossy brochures and run television commercials to sell their product to other people. It's a brilliant business model for them, and a terrible deal for you. So, how do you protect yourself? You have to become a fee detective. When you look at a fund, the expense ratio should be one of the first things you check. And you need a mental framework for what's good and what's bad. Generally speaking, for a mutual fund, any expense ratio over 1% should be a massive red flag. You are starting in a significant hole that the fund manager has to outperform the market just to break even with a cheaper alternative. An expense ratio between 0.5% and 1% is more typical for an actively managed fund, but it's still a significant drag on your returns. You have to be absolutely convinced that the manager is a true genius who can consistently beat the market by a wide margin to justify that cost. And history shows very few can. An expense ratio below 0.5% is starting to get reasonable. And if you're looking at passively managed index funds, you should be looking for numbers below 0.1%. These days, many are practically free. But the expense ratio, as devastating as it is only the fee they're required to tell you about up front. It's the cost that's listed on the label. There's another, even more hidden cost, buried deep inside the fund's operations. It's a cost that doesn't show up in the expense ratio at all, but it can be just as damaging, if not more so. It's created by the very actions of the fund manager buying and selling stocks, and it's a cost you pay for indirectly without ever seeing a line item for it. This invisible force, this hidden cost, has a name: portfolio turnover. And understanding it is the key to unlocking the real, often disappointing, truth behind many monthly dividend mutual funds. So what is it? Portfolio turnover is simply a measure of how frequently the assets within a fund are bought and sold by the managers. Think of it like this. If a fund has a turnover rate of 100%, it means that, on average, the manager has sold and replaced every single stock in the portfolio within the past year. A 50% turnover means half the portfolio has been changed out. A low turnover rate, say 10%, means the manager is taking a long-term buy-and-hold approach, only making changes to about a tenth of the holdings each year. Now you might be thinking, so what? Isn't that the manager's job? To actively buy and sell to get me the best returns. And on the surface, that sounds right. But every single time the manager clicks buy or sell, it creates costs. Costs that are not included in that neat little expense ratio number. These are the costs that bleed your returns dry drop by drop. Let's break them down. The first and most obvious one is brokerage commissions. Just like you pay a small fee when you buy or sell a stock through your online broker, a massive mutual fund does too. Now, their fees per share are minuscule, fractions of a penny. But when you are trading millions upon millions of shares, those fractions of a penny add up to a mountain of cash. And who pays for that? You do. It comes directly out of the fund's assets, reducing your share value. But commissions are just the tip of the iceberg. The far bigger, more insidious cost is something called the bid-ask spread. This concept is so important, yet almost nobody talks about it. When you look up a stock price, you're usually seeing a single number. But in reality, there are always two prices: the bid price and the ask price. The bid is the highest price a buyer in the market is currently willing to pay for a stock. The ask is the lowest price a seller is willing to accept. The ask is always slightly higher than the bid. The difference between them is the spread. This spread is the profit for the market makers, the middlemen who facilitate the trades. And it's a direct, unavoidable cost of trading. When your fund manager wants to buy a stock, they have to pay the higher ask price. When they want to sell, they have to accept the lower bid price. Every single round trip, a buy and a sell, means the fund loses that spread. It's like a toll you have to pay every time you get on and off the stock market highway. For a small investor, it might be a few cents. For a mutual fund trading $1 billion worth of stock, that spread can translate into millions of dollars in hidden costs, all chipped away from your investment. And it gets even worse. There's a third cost called market impact. Imagine a mutual fund manager decides to sell 1 million shares of a company. A fund that big can't just dump all those shares on the market at once. The sudden flood of supply would overwhelm the demand and cause the stock price to plummet. Their very own action of selling drives the price down while they are still trying to sell. So they have to sell it off in chunks, but even so, their massive presence in the market creates downward pressure. They end up getting a worse average price than the price they saw on their screen when they started. The same thing happens when they buy. Their huge demand can push the price up, forcing them to pay more. Their own size works against them. This market impact is another massive, unlisted cost that directly reduces your returns. So you have commissions, the bid-ask spread, and market impact. All of these are direct results of trading. The more a fund manager trades, the higher the portfolio turnover. The more these costs stack up, creating a powerful headwind against your investment's growth. This is where we have to connect it all back to our monthly dividend mutual funds. Why would these specific funds be more prone to high turnover? It's baked right into their mission. The relentless pressure to generate and pay out a consistent, high dividend every single month can force a manager's hand, leading them to make decisions that aren't necessarily in the best long-term interest of the fund's growth. Think about the mandate. The manager must produce enough income to cover that monthly check to you. This can lead to a behavior called yield chasing. A manager might sell a wonderful, stable, growing company like Microsoft that has a modest dividend, and use the cash to buy a stock in a riskier, more volatile sector that happens to be paying a higher dividend, just to juice the fund's monthly income number. This isn't an investment decision based on the quality of the business. It's a decision driven by the need to meet a short-term income quota. This constant swapping of lower-yielding stocks for higher-yielding ones inherently drives up turnover and all the costs that come with it. Furthermore, many of these funds don't just rely on dividends from stocks. To generate that high monthly income, they often turn to more complex, active strategies, most commonly writing covered call options. We don't need to get into the weeds of how options work, but here's the simple version. A manager sells the right for someone else to buy a stock from the fund at a certain price in the future. For selling this right, the fund receives cash called a premium right now. This premium is pure income that can be paid out to you as part of your monthly dividend. Sounds great, right? Free money. But this is an intensely active strategy. These options contracts typically expire every single month. That means the fund manager is constantly, month after month, selling new options, managing existing positions, and potentially having stocks called away, which forces them to sell. This strategy, by its very nature, creates an enormous amount of trading activity. It's the definition of high turnover. Some funds might even engage in something called a dividend capture strategy. This is where a fund will buy a stock right before it's scheduled to pay its dividend, hold it just long enough to be eligible to receive that payment, to capture it, and then sell the stock almost immediately afterward. This is pure, unadulterated churning. It's manufacturing income by creating a whirlwind of trades with all the commissions and bid-ask spread costs that entails, all for the sake of being able to send you a check. But the damage doesn't stop with trading costs. This high turnover creates a second, even more devastating problem for many investors: tax inefficiency. This is a big one. Every time a fund manager sells a stock for a profit, it creates what's called a realized capital gain. And by law, mutual funds are required to distribute these net capital gains to their shareholders at least once a year. And guess what? You, the shareholder, have to pay taxes on that distribution. This is crucial. You pay taxes on it even if you automatically reinvested that money back into the fund. You never touch the cash, but you still get a 1099 tax form in the mail with a bill for Uncle Sam. If the stock was held for less than a year, which is common in high turnover funds, it's considered a short-term capital gain, and it's taxed at your ordinary income tax rate, the highest rate there is. So let's put this all together. Your monthly dividend fund is frantically trading to generate income. This trading racks up hidden costs from commissions and spreads. The profits from that trading are then distributed to you, creating a tax liability that you have to pay out of your own pocket. The very process designed to give you income is simultaneously creating hidden costs and visible taxes that erode your total return. It's like trying to fill a bucket with water while someone is drilling holes in the bottom. You see the water going in, that's your monthly dividend check, but you don't see how much is leaking out through the bottom from costs and taxes. And over time, that leakage can be the difference between reaching your financial goals and falling desperately short. So let's pull back the curtain and inspect that bucket. Let's shine a bright, unforgiving light on every single one of those leaks, because they are the silent killers of wealth. The first and most obvious leak is the one printed right there in the fund's prospectus, though it's often buried in fine print. It's called the expense ratio. Think of the expense ratio as the annual management fee. It's the price you pay the fund company for the privilege of them managing your money. It's expressed as a percentage of your total investment, and it's deducted from your account automatically every single day, whether the market goes up, down, or sideways. You never write a check for it. You never see a bill. It's just gone, a ghost in your financial machine. Now, you might see an expense ratio of say 1% and think, 1%? That's nothing. I tip my barista more than that. And that's precisely what the fund companies want you to think. They've mastered the art of making a large number sound small. But let's translate that percentage into cold, hard dollars. If you have $100,000 invested in that fund, a 1% expense ratio means you are paying them $1,000. This year, and next year, and every single year after that, you're paying a $1,000 subscription fee just to own your own assets. But the real damage, the true devastation, isn't the $1,000 you lose this year. It's the compounding growth you lose forever. Albert Einstein supposedly called compound interest the eighth wonder of the world. He said, "He who understands it earns it. He who doesn't pays it." When you pay a high expense ratio, you are permanently on the wrong side of that equation. Let's run a quick scenario. Imagine you invest that $100,000 and it earns an average of 8% per year for 30 years. Without any fees, that nest egg would blossom into over $1 million. A life-changing amount of money. Now let's introduce that seemingly harmless 1% expense ratio. Your return is no longer 8%. It's 7%. What's the difference? At the end of 30 years, your account would be worth not $1 million, but around $760,000. Let that sink in. A 1% fee didn't cost you $30,000 over 30 years. It cost you $240,000. It vaporized $250,000 from your retirement. It's the difference between a comfortable retirement and a lavish one. The difference between retiring at 60 or 65. That is the catastrophic power of a seemingly small leak, compounded over time. But hold on, because the expense ratio is just the first leak. It's the one they're required to tell you about. The next leak is far more insidious, because it's not included in the expense ratio at all. It's the cost of the fund's own trading activity. This is measured by something called the turnover ratio. A fund's turnover ratio tells you how often the manager is buying and selling the stocks and bonds inside the portfolio. A turnover ratio of 100% means that, on average, the manager has replaced every single holding in the fund within the last year. Now, you might think a busy manager is a good manager. They're active. They're making moves. But in the world of investing, hyperactivity is a wealth destroyer. Every time the fund manager buys or sells a security, it generates costs. There are brokerage commissions. There are bid-ask spreads, which is the tiny difference between the buying and selling price that the market maker pockets. These costs are not paid by the fund company. They are paid by the fund itself, meaning they are paid by you. They come directly out of your returns before you ever see them. It's like hiring a contractor to build your house. The expense ratio is their stated management fee. But the turnover costs are like them constantly buying materials, returning them, buying different ones, and charging you for all the delivery fees, restocking fees, and wasted time along the way. You don't see a separate bill for it. The final cost of your house is just mysteriously higher. High turnover funds are notorious for this. Their managers are often chasing performance, trying to time the market, and all that frantic churning just racks up hidden costs that act as a constant drag on your performance. A fund with a seemingly low expense ratio can have a sky-high turnover ratio, making it far more expensive in reality than it appears on the surface. So now we have two leaks: the expense ratio you can see and the trading costs you can't. But we're not done. There's a third leak, and for many people, especially retirees in a taxable account, this one is the most devastating of all. It's tax inefficiency. The promise of a monthly dividend check is incredibly alluring. But here's the critical question you have to ask. Where is that dividend coming from and how is it taxed? Not all investment income is treated equally by the IRS. Far from it. There's a huge difference between qualified dividends and non-qualified dividends. Qualified dividends, which typically come from holding common stock in U.S. companies for a certain period, get favorable tax treatment. They're taxed at the lower long-term capital gains rates, which for many people can be 15% or even zero. Non-qualified dividends, on the other hand, are taxed as ordinary income. That means they're taxed at your highest marginal tax rate, which could be 24, 32, even 37% or more. Many monthly dividend mutual funds are a hodgepodge of different assets. To generate that consistent monthly payout, they often hold a lot of bonds, REITs, real estate investment trusts, or other high-yield securities. The problem is, the income from these sources is almost always non-qualified. The interest from bonds, taxed as ordinary income. The distributions from most REITs, taxed as ordinary income. So you get this nice steady monthly check, and then at the end of the year you hand over a massive chunk of it to Uncle Sam. Gets worse. Remember that high turnover ratio we just talked about? All that buying and selling doesn't just generate trading costs, it generates capital gains. And if the manager sells a position they've held for less than a year, that's a short-term capital gain. And how are short-term capital gains taxed? You guessed it, at your highest ordinary income tax rate. So these funds can become a tax nightmare. They're actively trading, creating taxable events. They're holding assets that spit out tax-inefficient income. And at the end of the year, the fund is required to distribute these capital gains to you, the shareholder. You get hit with a tax bill for the manager's activity, even if you never sold a single share yourself. You could see the value of your investment go down for the year and still owe taxes on it. It is the ultimate insult to injury. So let's put this all together. Let's look at the advertised yield on one of these funds. Let's say it's a juicy 7%. Looks great on paper. But then you subtract the 1% expense ratio. Now you're at 6%. Then you factor in the invisible drag from high turnover and trading costs. Let's be conservative and call that another 0.5%. Now you're down to 5.5%. Then the taxman comes calling. Because much of that income is non-qualified, you lose, say, 30% of it to taxes. Your 5.5% real return is now suddenly less than 4%. The advertised 7% yield has become a less than 4% reality. More than half of your potential return was siphoned off through the leaks in the bucket. Leaks for fees, leaks for trading, and leaks for taxes. This is the brutal, hidden math of monthly dividend mutual funds that the glossy brochures will never, ever show you. And it begs the question, if the underlying mechanics are often so inefficient, why are these products so unbelievably popular? Why do millions of intelligent people, from retirees to new investors, pour billions of dollars into them every single year? The answer has very little to do with math, and everything to do with psychology. It's a story, a powerful narrative sold by some of the best marketers in the world, designed to tap directly into our deepest desires for security and our greatest fears about the future. And this narrative, this story, is built on one of the most powerful psychological pillars in human finance: the deep-seated primal comfort of a paycheck. Think about it. For most of our adult lives, we are conditioned to a rhythm. Every 2 weeks or once a month, money appears in our bank account. It's predictable. It's reliable. It's the foundation upon which we build our entire financial lives. We use it to pay the mortgage, buy groceries, and plan for the future. This regular cadence of income isn't just a number on a statement. It's a source of profound psychological stability. It tells us that everything is okay, that the system is working. Now imagine you retire. That lifelong rhythm, that financial heartbeat suddenly stops. The paycheck is gone. In its place is a lump sum, a pile of money you've spent decades accumulating. And the new rule is you have to surgically remove pieces of this pile to live on. You have to go into your account and actively sell off a part of your life's work month after month. For many people, this feels terrifying. It feels like you're depleting your life force. Every time you sell shares, it can feel like a small failure, a step closer to running out of money. This is a powerful psychological phenomenon known as loss aversion. The pain of a perceived loss is far greater than the pleasure of an equivalent gain. Selling shares, even if the portfolio has grown overall, feels like a loss. This is where the monthly dividend fund swoops in like a superhero. It says to the anxious retiree, "Don't worry, I'll take care of it." You don't have to experience the pain of selling. You don't have to break that lifelong rhythm. I will restore the comfort of the paycheck. The fund effectively becomes your new employer. It deposits a paycheck into your account every single month, just like clockwork. The deep-seated anxiety of drawing down your principal evaporates, replaced by the familiar comfort of receiving income. The fund's marketing geniuses understand this better than anyone. They don't sell you a complex financial instrument. They sell you a feeling. They sell you the restoration of normalcy. They are selling you the ability to go to sleep at night without worrying about which shares to sell or if you're taking too much. You're no longer a retiree actively managing a drawdown strategy. You're simply a person collecting their monthly income. The psychological relief this provides is immense, and for many, it's worth a premium. It's a story that transforms a scary, unfamiliar new chapter of life, retirement, into a familiar and comfortable one. But the psychology runs even deeper. It taps into what behavioral economists call the action bias. We humans have a tendency to believe that taking action is better than doing nothing, even when inaction is the more logical choice. When you own a broad market index fund, the optimal strategy for creating retirement income is often to just let it grow and periodically sell a small percentage. This requires a conscious, deliberate, and sometimes emotionally difficult action from you. You have to log in, look at the market, decide what to sell, and click the button. A monthly dividend fund brilliantly inverts this. It makes receiving income the default, the passive state. The money just shows up. No action required on your part. All the complicated, emotionally charged actions, the buying and selling of underlying assets to generate that cash, are happening behind a curtain, managed by the fund. The fund takes on the action, so you don't have to. You get to be a passive recipient, a passenger on the airplane rather than the pilot having to navigate the turbulence. This offloads a massive cognitive and emotional burden. The fund isn't just managing money, it's managing your decision fatigue and your anxiety. It's selling you convenience and simplicity in a world that feels overwhelmingly complex. Then there's the free money fallacy, also known as mental accounting. Our brains are funny. We tend to put money into different mental buckets. There's the principal bucket, our sacred nest egg that we must protect at all costs. And then there's the income bucket, the fun money, the spendable money. Even though we rationally know that a dividend is simply a portion of the company's total value being returned to us, causing the share price to drop by a corresponding amount, it doesn't feel that way. When that dividend payment hits your account, separated from the principal, it feels like a bonus. Feels like a reward. It feels like your investments are generating free cash, like an apple tree dropping fruit. You're not touching the tree itself, you're just collecting the apples. This mental separation is incredibly powerful. Selling a share from your principal bucket feels like chopping off a branch of the tree. It's destructive. Receiving a dividend feels like harvesting the fruit. It's productive. This is a complete cognitive illusion, of course. The total return is all that matters. A $100 tree that gives you $5 in apples becomes a $95 tree. A $100 tree that you chop a $5 branch off of also becomes a $95 tree. The net result is identical, but the emotional experience is night and day. The marketing of these funds leans heavily on this illusion, using words like payout, distribution, and income stream. This language reinforces the idea that you are receiving something extra, rather than just getting a piece of your own money back in a different form. Finally, there's the irresistible allure of the simple solution. Retirement planning is one of the most daunting financial puzzles a person will ever face. You have to think about asset allocation, safe withdrawal rates, sequence of return risk, inflation, longevity risk, and on and on. It's a minefield of jargon and uncertainty. It's incredibly stressful. Into this chaos walks the monthly dividend mutual fund with a simple, elegant promise. Give me your money, and I will give you a check every month for the rest of your life. It is the ultimate easy button. It's a single, tidy solution to a messy, sprawling problem. It promises to distill all that complexity down to one simple, reliable number that appears in your bank account. This promise is seductive because it offers clarity in a fog of confusion. It allows the investor to outsource not just the management of their money, but the management of their worry. They no longer have to be the expert on withdrawal strategies or rebalancing. They just have to be an expert on cashing a check. This isn't just a financial transaction. It's an emotional one. The investor is buying a product, yes, but what they're really purchasing is peace of mind. They are paying for a story that tells them they have made it, that they are secure, and that the complex part is over. So when you combine these four powerful psychological forces, the comfort of the paycheck, the offloading of action, the free money fallacy, and the seduction of simplicity, you don't just have a financial product. You have one of the most compelling narratives in the investment world. It's a story that speaks directly to our deepest human needs for security, predictability, and simplicity. It's a story that makes people feel safe. And that feeling, that powerful narrative, is often more persuasive than any spreadsheet or total return chart could ever be. The real question then becomes, what is the hidden cost of buying into this story? What is the price you pay for this manufactured peace of mind? That price is paid in three currencies. The first is obvious but often underestimated. The second is subtle but financially corrosive. And the third is the most devastating of all, because it's a cost you don't even see until it's far too late. The first currency is fees. We call them expense ratios. It sounds benign, doesn't it? A ratio. A small percentage. Most of these actively managed monthly dividend funds carry expense ratios that hover somewhere between 0.5% and a full percent, sometimes even higher. 1%, you might think. What's 1%? It's nothing. It's the cost of convenience, the price of professional management. But that 1% is a silent thief, a termite in the foundation of your financial house, eating away at your future year after year after year. Let's put it in perspective. Imagine two investors, Alex and Ben. Both inherit $100,000 on their 35th birthday. Both are disciplined. They invest it and don't touch it for 30 years, aiming to retire at 65. Both investments earn a hypothetical 8% average annual return before fees. The only difference? Alex invests in a typical monthly dividend mutual fund with a 1% expense ratio. Ben, on the other hand, chooses a simple low-cost S&P 500 index fund with an expense ratio of just 0.04%. For the first few years, the difference is barely noticeable. A rounding error. But compounding is a force of nature, and it works for fees just as powerfully as it works for returns. That 1% fee isn't just 1% of your initial investment. It's 1% of your total growing balance every single year. It's a parasite that gets fatter as its host gets bigger. After 30 years, at age 65, Ben, with his low-cost index fund, has a portfolio worth approximately $965,000. He's ready for a comfortable retirement. But what about Alex? That seemingly tiny 1% fee has siphoned off a staggering amount of his wealth. His final balance is only about $761,000. That's over $200,000 that vanished into the pockets of the fund company. $200,000. That's not a fee. That's a new car, a decade of dream vacations, a grandchild's college education, all gone. Sacrificed on the altar of a monthly check and the illusion of active management. The cost wasn't 1%. The cost was a significant portion of his financial freedom. The second currency you pay with is taxes. This is where the story gets even more insidious, especially if you hold these funds outside of a tax-sheltered retirement account like a 401k or an IRA. The beauty of the monthly dividend story is getting that cash in your account. But in a taxable brokerage account, every single one of those 12 annual payments is a taxable event. The IRS sees that dividend and holds out its hand every single time. You're not just paying taxes, you're often paying them at the highest possible rate. Not all dividends are created equal. There are qualified dividends, which come from holding common stocks for a certain period and are taxed at lower, long-term capital gains rates. Then there are non-qualified or ordinary dividends. These are taxed at your marginal income tax rate, the same as your salary. It's the highest rate you pay. And guess what many of these monthly dividend funds generate to smooth out their payments? They use bonds, preferred stocks, or complex option strategies, all of which tend to spit out non-qualified dividends. So, you're not just getting a monthly check, you're getting a monthly bill from Uncle Sam, and it's a bill calculated at the least favorable rate possible. This creates a phenomenon known as tax drag. It's the silent headwind slowing your portfolio down. Compare this to a growth-oriented fund that pays very little in dividends. The value of your shares grows and grows, compounding tax-deferred inside the fund. You are in complete control. You decide when to sell shares and realize a capital gain, and therefore you decide when you pay taxes. With a monthly dividend fund in a taxable account, you have no control. The fund manager's decisions trigger a tax liability for you, month after month, whether you need the cash or not. It's like trying to fill a bucket with a hole in it. You keep pouring your savings in, but a portion is constantly leaking out to taxes, dramatically reducing the power of compounding over time. The peace of mind from the monthly check is paid for with a loss of control and a significant, permanent reduction in your after-tax returns. But the third cost is the most profound. It's the one that can change the entire trajectory of your life. It is opportunity cost. Opportunity cost is the ghost of the road not taken. It's the potential gain from the other, better investment you gave up on. Monthly dividend funds are, by their very nature, compromised. Their primary objective isn't to achieve the highest possible total return for you. Their primary objective is to deliver that smooth, consistent monthly dividend. To do this, they often have to make suboptimal investment choices. They might overweight sectors that are traditionally high yield but slow growing, like utilities or consumer staples. They might be forced to hold on to a deteriorating company simply because it pays a high dividend, instead of selling it and moving into a more promising growth opportunity. They might use those option strategies we mentioned, which can generate income but often cap the fund's upside potential. If the market rips higher, you don't get to participate fully, because the fund has essentially sold away that potential for the certainty of a small monthly premium. Think of it like this. You have a choice between two cars for a cross-country road trip. One car is a very comfortable, reliable sedan. It never goes above 55 miles per hour, but the ride is incredibly smooth. The other car is a modern, high-performance vehicle. The ride might be a little firmer, and it requires a bit more attention, but it can safely and efficiently travel at 80 miles per hour. The monthly dividend fund is the sedan. Feels safe, predictable, comfortable. The high-speed car is a simple, total return-focused index fund. By choosing the sedan, you're not just choosing a slower speed. You are choosing to arrive at your destination, financial independence, years, perhaps even a decade, later than you otherwise could have. The comfort of the smooth ride at 55 miles per hour cost you years of your life in retirement. Let's run the numbers one last time. Let's forget the fees and the taxes for a moment and just focus on the engine of growth. Historically, the S&P 500 has delivered a total return of around 10% per year. A well-run but income-focused fund might be proud to deliver a total return of 7% per year. 3%. It sounds like nothing, right? On a $100,000 investment over 30 years, that 3% difference in annual return is not a small number. At 7%, your investment grows to about $761,000. At 10%, it grows to over $1.74 million. That is $1 million difference. $1 million. That is the opportunity cost. It is the price of the story. It's the wealth you unknowingly sacrifice for the psychological comfort of a monthly drip of cash. These three costs, the high fees, the tax inefficiency, and the crippling opportunity cost, don't exist in isolation. They form a vicious cycle. The high fees reduce your principal, giving you less money to grow. The tax drag stems from the growth you do achieve, further slowing you down. And the underlying investment strategy is already designed to be a slower engine, prioritizing income over the total return that actually builds life-changing wealth. It's a trifecta of underperformance, all wrapped up in the comforting, seductive narrative of a monthly paycheck. So, if the very structure of these funds is so often a trap, why do millions of people pour billions of dollars into them? And if you are someone who genuinely needs income from your portfolio to live, what are you supposed to do? Is there a better way to turn your nest egg into a reliable stream of cash without paying this devastatingly high price? The answer is a resounding yes. There is a better way, a cheaper way, a more powerful way, and it all starts with a fundamental shift in how you think about your money. For decades, the financial world has sold this idea of a pristine separation. You have your principal, which you never touch, and you have the income it generates, which you live on. It's a comforting thought, like a farmer living off the apples from his orchard without ever cutting a branch. But what if that orchard is growing so fast, sprouting new, healthy branches every year, that selectively pruning a few and selling the wood would give you far more to live on than just waiting for the apples to fall? What if the fees the apple collector charges you are so high that they're secretly stunting the growth of the entire tree? This is the core difference between the high-fee monthly dividend fund approach and what is known as a total return strategy. The monthly dividend fund is obsessed with one thing: shaking the tree as hard as possible to make apples fall, even if it damages the branches. A total return strategy, on the other hand, focuses on making the entire tree, the trunk, the branches, the leaves, as big and healthy as possible. It recognizes that your wealth isn't just the apples, it's the whole tree. So how do you turn the health of the whole tree into cash you can spend? It's almost embarrassingly simple. You create your own monthly paycheck. Instead of waiting for a company to decide when and how much to pay you in a dividend, you decide. You do this by periodically selling a very small portion of your investment. Whoa, hold on. You might be thinking, sell my shares? Isn't that the cardinal sin of investing? Isn't that eating my seed corn? This is the single biggest psychological hurdle to overcome, but I want you to hear this loud and clear. A dollar is a dollar. Whether that dollar arrives in your bank account because a company paid a dividend, or because you sold a share that has grown in value, it is the exact same dollar. Your brain might feel a difference, but your bank account does not. The source is irrelevant. The impact on your portfolio's total value is what matters. Let's make this real. Let's stage a head-to-head battle. Two retirees, let's call them Frank and Grace. Both have a $500,000 nest egg, and both need $20,000 a year to supplement their Social Security. That's about $1,667 a month. Frank goes the traditional route. He finds a monthly dividend mutual fund. Let's call it the Reliable Income Fund. It has a juicy-looking dividend yield of 5%, which sounds perfect. 5% of his $500,000 is $25,000 a year. That easily covers his $20,000 need. But hidden in the fine print is an expense ratio of 1%. Remember that from earlier? That's the fee. Frank doesn't think much of it. 1% sounds tiny. Grace takes a different path. She learns about the total return strategy. She invests her $500,000 in a single ultra-low-cost total stock market index fund. This fund owns a small piece of virtually every publicly traded company in America, from Apple to Zillow. It's the ultimate diversification. Its dividend yield is much lower, say 1.5%. And its expense ratio is a microscopic 0.03%. Year 1 begins. Let's assume it's an average year for the stock market. Frank's Reliable Income Fund is full of high dividend-paying stocks. These are often mature, slower-growing companies. So while it pays out its 5% dividend, the underlying value of the stocks in the fund only grows by 3%. The fund's total return before fees is 8%, 5% from dividends plus 3% from growth. Frank receives his $25,000 in dividend checks throughout the year. He spends $20,000 and reinvests the extra $5,000. But don't forget the fee. That 1% expense ratio on his $500,000 portfolio costs him $5,000. It gets quietly scraped off the top by the fund company. So what happens to Frank's account? He started with $500,000. The fund's investments grew by 3%, which is $15,000. So his balance is now $515,000. The $25,000 in dividends were paid out, bringing it back down to $490,000. He reinvested the $5,000 he didn't spend, so it's back to $495,000. And then the fund company takes its $5,000 fee. At the end of the year, Frank's portfolio is worth exactly what he started with, $500,000. He got his income, but his nest egg hasn't grown at all. He's running in place. Now let's look at Grace. Her total stock market index fund doesn't focus on dividends, just owns the market. In an average year, the U.S. stock market has historically returned around 10% total. So her $500,000 portfolio grows by $50,000, bringing its value to $550,000. But how does she get her $20,000 to live on? Well, the fund paid its 1.5% dividend, which is $7,500. So she has that cash. She still needs another $12,500. So once a year or once a quarter, she simply sells $12,500 worth of her shares. She prunes the tree. So what does her account look like at the end of the year? She started with $500,000. It grew by $50,000 to $550,000. She then withdrew her $20,000, $7,500 from dividends and $12,500 from selling shares. Her final balance is $530,000. Oh, and the fee? Her 0.03% expense ratio cost her a measly $150 for the entire year, not $5,000. Let's pause and look at the scoreboard after just 1 year. Both Frank and Grace took the exact same $20,000 out of their accounts to live on. But Frank's account is still at $500,000. Grace's account has grown to $530,000. She is $30,000 richer than Frank, simply by choosing a different strategy. She is not just living off her orchard. Her orchard is expanding rapidly. Now, imagine this difference compounding over 5 years, 10 years, 20 years. Frank's high fees and focus on slow-growth companies will act as a permanent anchor on his wealth, while Grace's low-cost, growth-focused strategy allows her wealth to compound dramatically. She'll be able to give herself a raise to combat inflation. She'll have more to leave to her kids. She'll have a larger cushion for emergencies. All because she wasn't afraid to create her own paycheck. The devastating price you pay for the perceived convenience of a monthly dividend fund isn't just the fee you can see. It's the growth you can't see. It's the opportunity cost. It's the difference between running in place and sprinting toward a wealthier future. And what about taxes? That's a fair question. When Grace sells shares, she might have to pay capital gains tax. But for most retirees, the tax rate on long-term capital gains is significantly lower than the rate on ordinary income. In fact, for many middle-class married couples, the federal tax rate on long-term capital gains is 0. In many cases, the tax situation is actually better when you sell shares than when you receive certain types of dividends. The system is not what they told you it was. The simple, comforting story of living off the income is often a marketing trick designed to steer you into high-fee products that enrich the fund company, not you. The real secret the wealthy have known for decades is that total return is all that matters. $1 from a dividend and $1 from a sale spend the same, but the path they take to get into your pocket can make all the difference in the world. So we've established a better way. A cheaper, more effective, and ultimately more profitable way to generate income from your portfolio. But how do you actually do it? How do you set up this system so it feels just as reliable as that monthly check? How do you decide when to sell and how much to avoid the fear of selling at the wrong time? In the final part, we are going to build a step-by-step blueprint for creating your own paycheck. A practical guide to turning your total return portfolio into a durable, reliable income machine. So let's build that machine. Right here, right now. This is the assembly guide for your personal income factory, the blueprint to paying yourself from your own investments, giving you more control, more flexibility, and very likely, more money than a monthly dividend fund ever could. Step 1. Build the engine. Before you can get a reliable stream of cash flow, you need a powerful, efficient, and durable engine driving your portfolio forward. And that engine is a simple, diversified, low-cost portfolio focused on total return. Forget obsessing over dividend yields. We're obsessing over the one thing that truly matters: the overall growth of your money. For most people, this engine can be shockingly simple. Think of 2, maybe 3 core holdings. A total U.S. stock market index fund, like VTI or VTSAX. This gives you a piece of thousands of American companies, from Apple to the smallest startup. You own the whole haystack. Next, a total international stock market index fund, like VXUS or VTIAX. This ensures you're not just betting on one country's economy. You own a piece of the entire developed and emerging world. These 2 funds together give you a stake in global capitalism. They are your growth engine. Now, every engine needs shock absorbers. That's where bonds come in. A total bond market index fund like BND or BNDX acts as the stabilizer. When the stock market is volatile and dropping, high-quality bonds tend to hold their value or even go up. They are the ballast that keeps your ship steady in a storm. The exact mix, your asset allocation, depends on your age and risk tolerance. A younger investor might be 90% stocks and 10% bonds. Someone nearing retirement might be closer to 60% stocks and 40% bonds. The key isn't the exact percentage. It's the principle. You build a robust, globally diversified portfolio of stocks and bonds. You're not chasing dividends. You're capturing the total return of the entire market. This is your foundation. It's simple, it's cheap, and it's historically been the most effective way to build wealth. Step 2. Determine your paycheck size. This is where we replace the dividend yield with a much smarter concept: a withdrawal rate. You've probably heard of the 4% rule. It's a landmark study that found that retirees could withdraw 4% of their portfolio's initial value in year 1, adjust that amount for inflation each subsequent year, and have a very high probability of their money lasting for at least 30 years. So if you have $1 million portfolio, your first-year paycheck is $40,000. If inflation is 3% the next year, you give yourself a raise and withdraw $41,200. This was a game-changer because it shifted the focus from unreliable income and yield to the portfolio's total return. But we can make it even better. The 4% rule is a bit rigid. A more modern and flexible approach is to use dynamic withdrawal rules, or guardrails. Instead of blindly taking out the same inflation-adjusted amount every year, you adjust based on how your portfolio is doing. Think of it like a thermostat. You set a target withdrawal rate, say 4.5%. But you also set an upper and lower guardrail. Maybe if the market has a fantastic year and your withdrawal rate as a percentage of your new, higher portfolio value drops to 3.5%, you give yourself a 10% raise. You take a bit more cream off the top. Conversely, if the market has a terrible year and your withdrawal rate jumps to 5.5% of your now smaller portfolio, You take a 10% pay cut for that year. You tighten your belt. This simple adjustment dramatically increases the odds of your money lasting a lifetime. It forces you to be disciplined, to spend a little less when the portfolio is down, and allows you to enjoy the fruits of your labor when it's up. You're no longer a passive passenger. You're an active pilot, making small course corrections along the way. Step 3. Automate the paycheck. This is the magic step. This is where we silence the voice that says, "But I'm scared to sell my shares." We're going to create the exact same psychological comfort of a monthly dividend check, but with you in complete control. Here's how it works. You go into your brokerage account, Fidelity, Schwab, Vanguard, it doesn't matter which one, and you look for a feature called automatic withdrawals or recurring transfers. You then set up a rule. For example, on the 1st of every month, sell enough shares of my total stock market fund to equal $3,000 and transfer that cash to my checking account. You set it and you forget it. On the 1st of every month, like clockwork, $3,000 appears in your bank account. It feels identical to a dividend payment. It is your new paycheck. And let's tackle that fear of selling head-on. The fear comes from a psychological bias called the endowment effect. We feel that the shares we own are more valuable than the cash they represent. We hate to see our share count go down. But this is a mathematical illusion. Let's be crystal clear. From a total return perspective, there is zero difference between receiving a $100 dividend and selling $100 worth of shares. In both cases, your total investment value decreases by exactly $100. When a company pays a dividend, the share price drops by the dividend amount. It's a forced sale that you have no control over. When you sell a share, you are simply choosing to turn a piece of your ownership into cash. Imagine your portfolio is a giant block of gold. A dividend is when the fund manager comes by with a chisel and chips off a piece for you. Creating your own paycheck is you taking the chisel and chipping off the exact same size piece yourself. The block of gold is smaller either way. The only difference is who's holding the chisel. By selling shares yourself, you take control. You decide the size of the chisel. You decide when to chip. Step 4. Build a cash cushion. This is the ultimate defense against the biggest risk for retirees. Sequence of returns risk. That's a fancy term for being forced to sell your stocks after a major market crash, thereby locking in your losses. We avoid this with a simple cash buffer. You should aim to have 1 to 2 years' worth of living expenses sitting in something safe and liquid, like a high-yield savings account. This is your break glass in case of emergency fund for a bear market. When the market tanks 30%, you don't panic. You don't sell a single share of your stock funds. You turn off the automatic withdrawal plan and you live off your cash buffer for the next year. This gives your portfolio the most valuable thing in investing: time. Time for the market to recover. By the time your cash buffer is running low, the market has almost always started its recovery, and you can turn your automatic paycheck back on, selling shares at much healthier prices. This single strategy transforms you from a fearful investor into a resilient one. It's the difference between being a forced seller at the bottom and a patient investor who can ride out the storm. And that's the blueprint. A simple 4-step process. 1. Build a low-cost, diversified, total return engine. 2. Use a flexible withdrawal strategy to determine your paycheck size. 3. Automate the sale of shares to create that recurring, reliable income. And 4. Keep a cash buffer to insulate yourself from market downturns. This system is more tax efficient, it's more flexible, it's cheaper, and it puts you in the driver's seat. You're no longer dependent on a fund manager's dividend policy. You're no longer paying high fees for the illusion of a monthly check. You have become your own chief financial officer. The entire journey of this series was to unravel a myth. The myth that dividends are free money, and that a monthly dividend check is the holy grail of retirement income. We've seen that the real goal isn't income. The real goal is freedom. It's the freedom to live the life you want, funded by the assets you've painstakingly accumulated. And that freedom doesn't come from an overpriced, tax-inefficient fund that sends you an allowance carved out of your own money. It comes from understanding how wealth truly works. It comes from building a system that serves you, not the other way around. You don't need to hunt for yield. You need to build a machine. And now you know exactly how to do it. You have the blueprint. The rest is up to you.